Good morning. This is Ken Long from Tortoise Capital with an executive summary of the 5-day down swing trade concept. This only really needs one slide to describe the essential idea. This comes from work pioneered by Larry Connors, who wanted to examine the statistical outcomes of performance going forward after a symbol had been down for a certain number of days. And so what he did was studied all of the symbols on the New York Stock Exchange going back 30 years and did some massive computations and examined the following things. He said, let me find all the cases where any of those symbols were down for one day, and then let me buy the close and hold it for one day and sell the close the next day. And then that would be a symbol that had been down for one day and then held for one day. And then let me take those, and it was down for one day. Now let me close it out 2 days later, then 3 days later, then 4 days later, and so on all the way out to 10. And then he went back through that data set and said, now let me find all of the symbols that were down 2 days in a row and check their performance after 1 through 10 days, and so on all the way out until he had computed the 10 days down to 10 days holding for all of those symbols in the New York Stock Exchange for 30 years. And what he found was, when he found the performance characteristics of each of those 100 bins, that there was a persistent, robust, small but measurable performance improvement in the areas around 3 days down and holding for 3 to 6 days, all the way out to down for 6 days in a row, holding from about 3 to 6 days. And that the ones around down 4 and hold for 4 and hold for 5, and down 5, hold for 4 and 5, that was a sweet spot inside that region of outperformance. Small but measurable and statistically significant. And so there was not necessarily enough room to trade all of those. He nevertheless found that there was like tidal currents that were available. So to update this, we went through and did a 10-year back test from 96 to 2006 and considered all of these symbols, and we analyzed it by all market conditions, and we found that that link persisted. And so rather than simply buying the next day's open or buying today's close, as was done in Connor's test, we added some structure to the data set and those insights, and said we would buy it if and only if on the next day that the price went above the previous day's high, and that would be an indication that there was some reversion to the mean or a long side move after that period of selling. And so we wanted to see some evidence that the predicted move was actually occurring. We used that as the entry, and then in order to standardize the risk based on range, we used a 5 cents below yesterday's low as the signal for failure. So that would be what we call range risk. Buy at 5 cents above, put an initial stop 5 cents below, and that allowed us to develop a standardized approach to making this trade. Could you also use a multiple of ATR? You certainly could. That would be logical and consistent as well. But for purposes of this system, I went with what we were using. That was, we wanted a signal that was incontrovertible that the price action had failed, and that was if it went below the low of the setup date. And so this is the basic concept behind 5 days down. And one of the things that we get with our system is that if you were down 5 days in a row, but then you didn't get that mechanical entry and it simply opened inside yesterday's range and then closed lower, you could actually see some 5DD setups becoming 60D, 70D, and so the signal continues to be available provided you get these lower closes. And the only thing that you need to know on this one are the closing prices, so we don't use any of the intraday data as far as qualifying the trades or not. This is a robust system, one in which there's a lot of goodness in a lot of different markets. It only needs 5 days in a row, so it doesn't really care what the long-term market conditions are. We've found later that the 5-day down failure in bear markets is an outstanding signal to immediately get short intraday. And we also found that the continuation patterns on 5DD were also valid signals to take. And this has become a bread and butter system forming. So that's the 5DD concept. You'll see the words and the system definition map it out clearly. But this is the origin and the main idea behind the system. And so now here are some setups from a week of swing signals for the 5DD. Here's one in Intel, and you can see this is day 5, day 4, day 3, day 2, day 1. So you've got the 5 days down in a row. And what I typically use for target for computing reward to risk ratio is the 10-day high. And so I would just plot a return to 26.9, and my entry would be 25.6, and I'd be using about a 60-cent stop or 5 cents below. Here's another orderly decay in Alcoa from a high of about $10. So there's 1, 2, 3, 4, 5. And notice you can have white candles in here, but what matters is that the close was lower. This is one in which you would also notice that the a channeling signal, if you're using it on the Dow components. At the time, this was in the Dow, as in 2016, it's not. So you actually have a channeling signal in here as well. Here's one in the S&P 500, where you can see the 5 days down. Robert Gardner would call that the red Niagara. You also notice a channeling signal in play here as well. So again, it only has to have 5 days down in a row to give us that signal. So that's what the signal looks like, and robust system, and one of my favorites.